Welcome to Finance This, Property That. My name's Dion Fernandez, and this podcast is for property enthusiasts, time-poor professionals, self-employed borrowers, and strategic investors looking for residential or commercial property who want more than just a low interest rate. They want a strategy and a team around them. Each week, I'll share strategies, structures, and lending moves that actually grow wealth, not just get you the loan. And also, I will help you surround yourself with information from professionals in their field. If you're here to build smart, not slow, you're in the right place. My vision is to empower financial legacies for generations. I am a mortgage planner and finance strategist, and I work with doctors, developers, business owners, and high-income earners to build serious property portfolios. So without further ado, let's get into today's episode. Hey everybody, welcome to this episode of Finance This, Property That. Today, very, very hot topic, especially with the way the market's going at the moment, getting a lot of clients wanting to build property portfolios. So today, I want to talk about how do you build a property portfolio without running out of borrowing power. Now, one of my previous episodes, I talked about trust lending. That is one of the ways we can do it, but I'm going to go into a few more details through in this one. Now, obviously, well, not obviously, but owning one property, generally, maybe one or two, generally fairly easy. Owning 4 or more and then diversifying into different types of properties, that's a whole strategy that that you need to have. You can't just walk in and do it unless you're a gazillionaire. Well, that's a completely different thing. You won't need to talk to me about it. You just pay cash for everything. But let's talk about today, how do you structure lending to scale without blowing your borrowing power out? So the big question that you're probably wondering is why most investors get stuck after 1 or 2 properties. Well, here's a couple of reasons. The main reason I see is that they are using one bank and paying the loyalty tax. Now, the issue with using one bank is that you only get one policy and you only get one type of product. And sometimes the lenders that you speak to aren't experienced and don't understand how to grow a portfolio, or they're actually really good at what they do, but they're limited by their actual policy. Some of my close friends are lenders within the big banks, and they're really excellent at their job. But when we're having a discussion, I know that they're hampered by their policy. That's why they come and speak to me and figure out if I can help their clients, which most of the time I can do, and I've got some awesome relationships with them. The other one is that the broker that you started with is probably not the broker that's going to take you to 3, 4, 5, 6 and diversify your investment and keep on track of it. Mainly because you've outgrown them. They're really good for the first property and the second property, but then, when you start to use structures and, your complex income, etc., when it's just not easy, that's what I've seen a lot of my clients come and said, I've used a broker before. My current broker's already said that they can't do it. It's not within their wheelhouse. And that's where, you need to outgrow your broker. Not saying that they're a bad broker. They just don't do what you need them to do. And that's okay. The next part, you as a property buyer, you as someone that's wanting to start scaling a portfolio, you're looking at the rate as being the overarching thing as whether you buy this property or not. You need to look at, stop chasing the rate. I've done a little reel on this. Stop chasing the rate, especially when you're trying to scale. The most important thing is policy and borrowing power. We can figure out and worry about the rate later, because that's when it matters, when you are not in the acquisition phase, when you're not building and scaling. The next part that you also look at is the repayment structures aren't right to maximize cash flow. So you've got I had a couple of clients that had all their repayments on P&I, and when I asked them why, they said, the rate's cheaper. I said, yeah, but it's not maximising your tax benefits, but you've got more outgoings. And they said, oh, yeah, that's what our accountant said. I said, well, what have you done about it? It's go, oh, well, that's why we're here to see you. So, we can restructure the debt, make it interest only. It actually frees up cash flow, maximizes the interest add back that you can have in your tax return as well. And there's a few other things that allows you to do. The main thing, though, we want to focus on paying down non-tax deductible debt like your owner-occupied property, because that's all debt paid with post-tax income. Whereas your investment is all pre-tax income because you've got deductions coming off it. The other thing I see a lot of where people get stuck is you actually don't have a plan and you're just buying property because it's a good deal, perceivably good deal. But if you don't have a plan, how do you know what structure to buy in, whether you can actually buy that property? Just because you've got equity and you earn an income doesn't mean you're actually buying that property in the right structure that'll stop you from growing. Which brings me to my next point. Your structure sucks. Yep, I said it. Your structure sucks because you're just you've gone to your bank or you've gone to your broker and you've just bought properties in your name. And I'm going to come to a case study where that's happened and we've had to untangle a little bit. But you've just bought property in your own name, and that actually caps your borrowing capacity because all those properties you've got to put that in your balance sheet. Whereas if you have a conversation early and you've got a plan, you can actually set up, okay, property 1, okay, owner occupied, that can be in my name. Property 2, that can be in my name because we can get a bit of tax out of it. Property 3, 4, 5, 6 may need to be in structures, and the structures will be determined by 1, your tax strategy, your buying strategy, and how much you want to scale, and your accountant, your broker, e.g. like myself, and maybe your financial planner all sit around with you and discuss the strategy, and that way we're all on the same page. Cool. So, how does lending change after potentially property number 2? Well, your servicing clearly decreases depending on the property you buy. Because if you still got a high owner occupied debt, that sucks the life out of your servicing because there's no tax benefit out of it. Equity releasing may get tighter. Lending credit scoring may get tighter and more conservative as well, depending on the type of property you're buying. This is why you need to have a clear strategy before you go buy property number 3, 4, 5. So we work that into the strategy. It's pretty simple. So what are some of the principles that you could use to build a scalable portfolio? It's a great question, and I answer it all the time. So a couple of things. Strategies I use will sometimes be using multiple lenders to spread the risk. What I mean is we may not normally have all the properties with one lender. We may spread that risk out to other lenders because the other lenders may have different policies that lender A doesn't have, but lender A still suits property 1 and 2. Property 3 may go to lender B, property 3 may go to lender C. And it's all about the policy. Rate at this stage is irrelevant when you're growing. It is relevant, but it's not as relevant. The other reason I do that is also it preserves borrowing power. Because if your trust or company trust structure, let's say we go to property B, property 3 goes to lender B, they may, and then you go property 4 goes to lender C. Lender C doesn't, as long as property 3 is looked after by itself, you sign a declaration or accountant's letter, it's fine. It's making its own repayments. It's looking after itself. We play on. We don't have to include that debt according to lender policy. We don't include that debt because it's self-sufficient. This is how you scale to property 3, 4, 5, and beyond. Then the other part is around mixture of your repayment strategy. When do you use interest only versus principal and interest? What loans are? So initially, You want to optimize cash flow while controlling exposure. So what that means is you want to start paying off. You want to have principal and interest. Generally is what I use principal and interest for is on your owner-occupied debt, because you want to pay that off, release equity so we can recycle some debt, go again. So you pay off that debt, recycle, we get the uplift in the value of the property, take some more cash out, go again. What that means is when we restructure it, the repayments are lower, it increases your borrowing capacity. With interest only, it increases your cash flow by not having more outgoings with your repayments until we finish buying, and then we can look at paying the debts down. We don't even have to borrow. If the capital growth's great, we can just keep the debt the same and the capital growth's grown, and time has done its thing. You're winning. The other part to build a scalable portfolio is the correct ownership structure. Should you be owning this in your personal name? Should you be setting up a company trust structure? Should you buy it in an SMSF? All great questions, all require different strategies, and all require individual experts like accountants and financial planners and good brokers that understand how to lend in those types of entities on your side. The other thing you can also do is the use of offset, which controls the debt, improves interest efficiency as well. So if you've got a bank that has multiple offsets and you've got 2 or 3 investment properties with them, and you've got an owner occupied and a couple of investment properties with them, well, really all your accounts should, if they've got multiple offsets, why aren't you having multiple offsets offsetting your owner occupied home loan? All the money is coming into those separate offsets. They're all used for different purposes, but they're offsetting your owner-occupied home loan. You're paying less interest, more principal, paying that loan off quicker, which means you're creating equity and paying down that non-tax deductible debt. Why are you paying interest to the bank when you don't need to and you can't claim anything back? I don't know. You tell me. The other thing is around being smart, your broker, being smart, broker or lender, doesn't matter what you use, each their own, being smart about valuations, because that's where it's made or break. This is why we have 2 to 3 different lenders, depending on the policy we need. So we can actually get valuations from 2 to 3 different lenders, because when you're growing, you need to have equity to grow if you don't have cash, because equity is like the cash inside your property that you pull out to go again. So smart values. So if a lender values your property at 900, but lender B values it at 950, there's 50 grand difference. And if we need 25 grand, but we can't get that out of the 900, well, then we're going to the 950 because that's what's needed at the time to scale. So how does this work in the real world? Well, one of my long-term clients, they're in an awesome position. However, their first property, owner-occupied, in their name. Their second property, investment, in their name. Third property, investment, in their name. Fourth property, investment, in their name. Unfortunately, they just got some bad structuring advice before they came and saw me, and I have now untangled the web. It's basically capped their borrowing capacity because of a couple of things. One, they used to be both PAYG, and one of them was PAYG and self-employed, so we had a great amount of income. Kudos to my client for taking the plunge, went full-time, self-employed, running his own business, absolutely smashing it. The business is doing so well that his wife has actually stopped her PAYG role and has gone into work for the business, which gives them all great work-life balance and able to spend more family time together. But then the 2-3 streams of income has gone down to 1 stream of income. Looked at the deal at the time. Before they did all that, we ended up restructuring all the debt, releasing some equity and preparing them for a purchase. But one caveat is that they had to sell one of their properties. We ended up looking at the numbers. They got some advice. They sold the property that was probably the least performing property. They actually made quite a bit of money out of it, paid down those debts. We freed up some equity. Then they decided to buy their next owner-occupied property because the house they were living in was too small. Great. There was no way I was refinancing any of their good debt or their cheap debt over. They had good amount of cash because we set them up for the next purchase. We were able to use some of that cash to buy the next property. We had to do that with an alt-doc solution, which is a temporary solution in liaising with their accountant to figure out what the actual net profit needs to be in the company, because there's a lot of cash, a lot of business going through there, which is awesome. Short-term solution, got them into their dream home, minimal debt. We'll restructure that debt out. Their current owner-occupied is now an investment. And we've got great opportunity now to go purchase another property, as well as maybe a commercial property, because there's enough equity in there to do that for them. And with commercial properties, there's a different level of servicing, which will be covered off in another podcast. So just want to run through a couple of common traps to avoid when you are trying to scale a portfolio. For heaven's sake, stop chasing rate. Because if you're trying to refinance everything to chase rate, you're actually losing a bit of flexibility and you're shooting yourself in the foot for growth, because rate is dictated by the policy you need for the borrowing power that you need. Number 2, cross-collateralisation of all your properties. What I mean by cross-collateralisation is property 1 and property 2 are being used for security against loan 1, 2 and 3. Whereas we don't need to do that. We can actually segregate the loans if there's enough equity. So property number 2, let's say that's an investment. We have 80% lent against that. Property 1's your owner-occupied, and you've got a lot of equity there. So you've got your owner-occupied loan. We take the 20% plus costs to lend to go purchase property number 2. If you want to sell property number 2, it really only affects the loan secured against property number 2 and not affecting the owner-occupied property as well. So again, we can talk about that in more detail. The other thing is you're rushing to grow at scale when you don't need to be. You don't need 10 properties on your portfolio. You just need maybe 3 to 5 really good quality assets that have great capital growth. They're in suburbs that are growing. You're actually using a buyer's agent to find those sort of properties, and you're sort of really then you're not underestimating the future potential rental income, because they're desirable suburbs. People will pay the money to live in those suburbs, and rents aren't going down; they're only going up. And also Queensland, or Brisbane in particular, is now a $1 million median house price city. So I hope you got something out of that. There is heaps more that I can talk about. That information is very general in nature, doesn't take into consideration your personal circumstances. If you want to have a chat with me, I'm really easy to find. Jump on Instagram at Dion Finance Specialist. I'm on LinkedIn, Dion Fernandez. This podcast also has got its own website, financespropertythat.com.au. Share, like, subscribe, tell your friends, follow along, doesn't cost you anything. And thanks for joining me on this episode, and I'll see you on the next one.